Hi, I'm Jasper Becker. I'm a writer and author, and I've been following China since the mid 1980s. And I've written about 10 books on China and its neighboring countries. So this channel is looking at where China is going, and in particular at its economic problems. So in this video, we're going to talk again about how China's economic problems resemble those of Japan's, and that Chinese leaders who are now in the midst of a kind of murky power struggle have to figure out how they're going to escape from the debt trap that China finds itself in. So what we've seen in China is very similar to Japan. We've seen that the Chinese leaders have, since 2008 and even earlier, but particularly since 2008, have launched a number of extremely large stimulus programs. And they've done this by not only encouraging an enormous amount of lending and very cheap credit terms, they've actually encouraged something which Austrian economists, the Austrian School of Economics, would call malinvestment. So that means that this excessive lending is not actually justified by savings or by economic demand, but is a false kind of economic activity which people lend for projects which have very poor or zero economic returns. And in China's case, this has meant they've actually invested an enormous amount of the economy, perhaps as much as 30% of GDP, into a property bubble. So property prices in the main cities have tripled over the last 15 years, and enough housing has been built to house the population 3 times over. And we now have enormous amounts of what they call ghost cities, urban developments which are unoccupied and will probably not be occupied ever. They'll probably have to be knocked down. So we're now seeing a slow motion property crash, and that is affecting the allied sectors, obviously people making cement, steel, glass, iron, all that kind of thing, furniture, all these kind of related industries are in big trouble because they've now got overcapacity. But from an economic point of view, the problem is that the government's only way out is to actually increase the debt. So it is coming up with new economic stimulus programs, and it's easing monetary restrictions, making it easier for people to borrow money. And so they're in great danger of repeating the mistakes that Japan has made. And so what we are seeing now is that China's debt to GDP ratio is very similar in profile to Japan. So it's probably around 350%. Some economic estimates by Goldman Sachs and others put it at probably closer to 400,000. So that's 4 times as much as, say, the UK or Italy. And it probably makes China the most indebted country in history. And the trouble is that a lot of the investments which have been made will probably continue to require massive subsidies for as far as the eye can see, particularly the very impressive high-speed railways that China has built. It's got the world's largest network of high-speed railways, a little bit like Japan pioneered high-speed railways too during the height of its boom. And what we're seeing this year in China is falling wages and falling prices. It's now in a deflationary spiral. And more concerning for Chinese investors, it's defaulting a lot on its overseas debts. So foreign bond holders are not being able to get their money back. And we're also seeing foreign investors pulling out. And there are a lot of rumors of bank runs as well, in which Chinese investors have been trying without success to take their savings out of some of the smaller local Chinese banks. And obviously, with a property crisis like this, it's very hard for local governments to carry on with the land sales, which have helped finance a lot of this economic expansion. And the other investments that China has made are also producing very poor economic returns. As far as we can see, the enormous investment in electric vehicles could prompt another economic crash similar to that which we've seen in the big property developers like Evergrande. So the pattern is quite similar to Japan's. So we have a country with undoubted economic success and a country which has become an extraordinary exporter, dominating many industries, but is in reality unable to produce real economic returns from its investment. So if you had invested in prime property in Hong Kong or Shanghai or Beijing and are trying to sell your property, you'll probably seen that prices have dropped by 50% from their peak and are probably still going to carry on falling. And secondly, if you'd invested in the Shanghai stock market or the Shenzhen stock market or the Hong Kong stock market, the returns have been pretty much close to zero over the last 20 years. So while China's economic boom was raging at its peak, the currency was actually appreciating. It is pegged to the dollar, and the Chinese government can allow this peg to move in small movements. But we're now seeing the renminbi being devalued, and therefore the fear is that Chinese people think that the renminbi could end up like the Japanese yen, which has lost 80 to 90% of its value against the dollar. So something similar might happen in China. And the likelihood of this happening, a kind of devaluation and therefore an export of deflation around the world, is quite strong, because I think if you're a follower of the Austrian school of economics, the only solution to this stage in the business cycle where you have too much soft lending, too much overinvestment, a lot of malinvestment, is to actually allow prices to quickly fall to their natural level and to absorb the losses quickly in order to restore health to the economy. But we know from past experience that the Chinese government is very reluctant to take these kind of measures. It much prefers to gradually, slowly let the air out of the bubble. And so I think the likelihood is therefore that you'd have a prolonged period when it would try and cope with this overexpansion of the economy. So that means, as in with Japan, you could see another 20 or 30 years of very poor economic returns in China before things return to normal. So we've got a lot of fiscal packages coming down the track in China. And what this means is that these packages are being used to keep a lot of zombie companies alive to prevent them from collapsing and people losing their jobs. And in order to hide the fact that a lot of private sector companies are going bankrupt, the government has been hiding a lot of economic data, particularly youth unemployment. We haven't seen any figures for a long time. And secondly, they're using the stimulus programs and emergency bailouts to keep alive the finances of local governments, which always depended very heavily on land sales. And obviously, these land sales are not really taking place anymore. And so the government, which had previously hid a lot of these debts in the local government offshore borrowing accounts, is now going to have to bail out local governments. And the only way it can do this really is by printing more money. And secondly, by trying to get rid of a lot of the surplus capacity. So they've got lots of electric vehicles, which are now being sold at secondhand prices and are being subsidized and dumped on international markets. And we're seeing that in many sectors like steel and copper and a great many other raw materials where China uses its very cheap electricity to produce metals from ores that it imports, and it then exports this. It also exports this in the form of ships and increasingly military hardware and all kinds of other products like textiles. So a lot of this stuff is going to be dumped onto the world market. And I think people are now becoming very well aware that the only way they can deal with this is either to impose tariff and non-tariff barriers on Chinese exports, or to force some new currency alignment. And I think because there is no easy way out of China's dilemma, that the good years have passed, I think that is why we're seeing a very acute power struggle within the Chinese leadership, because somebody has to take the blame for what is going wrong, and somebody has to shoulder the responsibility for writing down these debts. And it's going to be quite painful for many people. And therefore, we're going to see a lot of increased international tensions as well. People like the British government, who'd been hoping to capitalize on China's economic boom, are now finding that China is not such a good market for its products and is actually inclined to shut out imports in order to stimulate domestic demand for its own manufactured goods. So the problems are coming thick and fast for the Chinese economy. And I'm going to try and explain in a follow-up video about how exactly China got itself into this position in the first place. Why did it ignore the advice of many of its economic advisors and plunge into this artificially stimulated boom? And why did it think it could avoid the inevitable bust that followed? Thank you for listening. So if you enjoyed listening to this video and want to read some of my books about the history of China and Korea and Mongolia and other aspects of Asian history, you can find a list of my books on a link below. And you can also find details of my website and order books on Amazon or from my own website. Thank you.